Yeah, man, that's crazy. 40 days, God, I've been Swayze. Grew the beard out, that ain't shady. That's a bird, man, I ain't baby. Talking hope out, that's so crazy. How I got a shot, raise the bean sprout up, put a crown up on her head so the boys seeing, no, that's a lady. If you ain't catch a double that time on the last rhyme, dog, I could help you. I got plenty more where that came from. When I brainstorm, I need shelter. It's enough water from the most high, even low tide, he gon' wet you. Better learn how to dance in the rain, ain't no use without an umbrella. When I yap for the king, I'ma lap anything on the track. When I rap and I scrap in the ring, back in the Mac. When I cock back in the swing, get a pap and you gotta lay flat when it. That's a mantra. Change the way y'all see the Father. Sing praise to the Most High, so when most die, y'all see His honor. He was dripping with the backlash, and he let him zip him in the black bag. For the intermission was a hashtag, but the demolition wasn't that sad. It was intuition and a premonition, but the imposition wasn't that bad. It was cynicism with the inhibition, but the bigger vision was the last.
While the whole world is watching Iran right now, something happened this week that most people completely missed. Trump publicly went to war with the banks. And I don't mean metaphorically, I mean he called them out by name. And the reason why this matters to you is simple. The outcome of this fight will determine which side of the biggest wealth transfer of our lifetime you end up on. Banks aren't fighting stablecoins because they're dangerous. They're fighting them because stablecoins expose a part of the banking system that only works if you can't opt out. Now, on the surface, this gets framed as regulation or safety, maybe even politics. But that's not what's really happening. Now, this is a very quiet power struggle over who controls money once custody and settlement stop requiring permission. Now, if you've been following my work on stablecoins and liquidity expansion, then this is the resistance phase that always comes right before the money moves.
And I turn up to another level. We gon' give him all the praise, cause it ain't nobody better. We gon' turn up to another level. We gon' give him all the praise, cause it ain't nobody better. Can't help myself, I can't help myself. When I get to praising up in this place, I lose my breath, I can't help myself.
Why they party? I'm in here grinding. Money I'm stacking. Why they rock diamonds? I can't relate to them, ain't much in common. I set a goal for me 2 or 3 commas. 7 figures, 8 figures to 9 figures. On a slow pace to get rich quick. Same time we just think different. Cause when you make it, it hit different.
What it do, y'all? It's your partner Dale back in the set again for another edition of the Counter Move podcast. Every Thursday, guys, evening, you come kick with your partner. If you could, guys, do me a quick favor, guys. Like, share, and subscribe, guys. There's a little bit of a bell on the platform that's showing. Click on that thing so when your partner come live, you can kick it with me, man, and we can dive into a little bit real fast, guys. Guys, we got a nice topic today. We're gonna dive right into it because it's NCAA tournament time, and unfortunately, my team lost today. The UNC Tar Heels. It's all good, baby. But my Longhorns won, so it's all good. Guys, let's dive into the topic real fast. Guys, today, guys, we're gonna be talking about, man, the 1940s playbook returns. What do you mean, Liddell? Something about inflating the debt away. Yes, so we're talking about money today. Number 2. Trump versus the banks. Man, there's a power clash going on between Trump and the banks, and it centers all around cryptocurrency, guys. All right. Number 3, there is a war economy, right? And how you know it's a war economy? Follow the money. We're going to look at the globe as a chessboard, right? And the main piece is money, all right, and power. And then last, guys, we'll talk about what is your counter move with these money plays and this war economy, guys. Let's dive into it real fast, guys. Let's go to our first topic today, man. Yo, there is a 1940s playbook that has been used in the past. And it's dealing with inflation, yield control, and financial repression. And I'm going to explain it all today. All right, guys? This is around the debt clock. I'm gonna say this is around the U.S. debt, guys. So I want you guys to see this real quickly, real fast, guys. Let me get to it. That clock, this just came to my head right now. I want you guys to see this. Here's the clock. All right, here we go. I want you guys to see this debt clock. I want you to see it all. All right. Let me go ahead and share my screen real quickly again. Let me see here. Here is the U.S. debt clock. I want you guys to see this for yourself. All right. I want you to see it for yourself. All right. This is the debt clock. All right. Now I'm going to scroll down a little bit right here, guys. If you can see it, I'm going to get rid of this real quickly. Get rid of this overlay real fast. Right here, if you can see it. Here we bigger. Bow. There we go. You can see this, guys, real quickly. Right here, you can see it says our national debt is $39 trillion. $39 trillion. That is a lie. It is higher than that. Okay. In this figure, Medicare, Medicaid, and the Social Security they are not in this figure. Okay. Those are liabilities on the balance sheet. I want you guys to understand the word balance sheet. Okay, balance sheet. It's going to be mentioned a lot today. Balance sheet. All right. Number two, guys, right here. As we know, the government makes no goods or services at all. None. Zero. Not a damn thing. But they do have revenue coming in from taxes. Right. Right now they have $5.4 trillion coming in taxes right there. $5.4 trillion. All right. Now, guys, let's go over here. This right here says U.S. federal spending official $7.096 trillion being spent. So let me get this straight. We're bringing in revenue $5.4 trillion, paying out $7.096 trillion. Leaves us a deficit of $1.692 trillion. This is unsustainable. All right? This is unsustainable. Now, how in the world can the U.S. government get away with this? Simple. It's called deficit spending. We base our entire model is on a debt system. It's a leverage-based system. This is why you have right here. It says U.S. Gross domestic product. That's basically the valuation of our economy. $31 trillion. All right. I'm putting this all in real estate type of concept so you guys understand it. All this is the appraisal value of our U.S. economy. It's called the GDP, or gross domestic product. Right. $31 trillion. So we have $31 trillion in value. Right. Revenue coming in at $5.4 trillion in taxes coming in, and $7.096 trillion going out. This is unsustainable. Okay, it's unsustainable. Now, this is the reason why I want to bring this up, guys, is because of the fact that a lot of us don't understand this type of verbiage, guys. All right, this is the reason why I'm bringing up the 1940s playbook. Right. They are trying to inflate the debt away. All right? They're trying to inflate debt away because we can't pay back $173 trillion plus dollars. It is impossible. So they have to do one thing. They have to inflate the debt away. All right? Let's dive into this first video real fast because we're going to walk into this real quickly. And we're going to walk at how they're doing this. And I'm going to point you guys toward a term that you know that I always talk about. Cryptocurrency. Yes, sir. Crypto. The Genius Act, right, is a big beneficiary of this inflated debt away. You don't believe me? Watch this. Let's go to our first topic, guys, real fast. This is our good buddy, Mark Moss. Good guy, wise. Let's dive into this real fast. Here we go.
Between 1942 and 1951, the United States ran a playbook that took debt from 120% of GDP down to only 35%. But the thing is, they didn't pay the debt back.
What?
They inflated it away.
Huh.
They're running the same playbook again right now. Now, if you were using the most popular investing strategy that your maybe financial advisor pushes today, you would have gotten completely destroyed. And it's not because you picked bad stocks, because the strategy itself was designed to lose under those conditions. But the thing is that now, most people who figure this out, they know they need, outsized returns to beat it. So they start day trading. They start, complex option strategies. They're chasing crypto. They're chasing meme stocks. And most of them blow themselves up. But there's a strategy the top 1% use to take on far less risk with much better performance. It's got nothing to do with picking the right stock. So in this video, I'm going to break down the exact mechanism they used in the 1940s, why it's being run again right now, and the strategy that puts you on the right side of all of this. So let's go. All right, so let me show you where all this comes from. Now, the International Monetary Fund, they published a paper in 2011 titled The Liquidation of Government Debt. Now, this isn't some conspiracy, right? This is not a blog or fringe theory. The IMF, they documented this. The BIS also put this white paper out. And the IMF documented exactly how governments erase debt through what they call financial repression. And they put numbers on it. Now, the numbers, they're pretty brutal. Now, post-World War II, the United States had debt of 120% of GDP, and they couldn't pay it back, at least not honestly, right? Because the numbers didn't work. So they ran the playbook. In 1942, the Federal Reserve pegged Treasury bills at 0.3% and long-term bonds at 2.5%. That's called yield curve control. Now, they did that to maintain the peg. The Fed had to buy unlimited quantities of government securities. The Treasury issued the debt, and the Fed absorbed it. But here's what happened on the other side of that. You see, inflation ran hot. Inflation ran 8%, 14%, even as high as 18%. So your bond paid 2.5%. Your savings account paid maybe 1%. But if inflation is running 14% and your return is 1%, that means you're losing 13% per year. That was the policy, right? That's not volatility. That's what they meant to do. But it was that gap between what you earned and what inflation cost you transferred silently from the savers to the government. Now, of course, nobody announced this. Nobody voted.
This is the reason why people like Robert Kiyosaki say savers are losers. That's why he says it's not to insult you. Is to give you an accurate picture of how you may be getting screwed. Let's get to it.
Voted on this to happen, but it did happen year after year after year. Now, the IMF calculated that between 1945 and 1980, the United States liquidated debt at a rate of 3 to 4% of GDP per year through these negative real rates alone. That's how the debt went from 120% of GDP down to 35% over just 3 decades. Again, not because they paid it off, because they inflated it away. Now, the U.S. held the peg from 1942 to 1951. It was about 9 years. And by February of 1951, inflation was raging. Inflation hit 21% annualized. And of course, that caused the Fed to finally break. So they had to restructure. And they reached what's called the Treasury-Fed Accord. Now, the Fed regained independence. Rates were allowed to finally start moving again. But by then, the job was already done. Financial repression works by keeping interest rates lower than inflation. Now, when that happens, the real value of debt shrinks, which is great, right? But it's a transfer. It's a tax. It's a tax that nobody voted for, that nobody calls it even a tax. Now let's fast forward today, because what does that have to do with today? Well, today in the US, the debt is now 123% of GDP, about the same starting point as 1945. But now, what are we going to do? Well, there's only 4 ways that a government can reduce debt to GDP. The first one is that they could run a surplus, right? So they could grow their way out of it. They could make more money than they spend, but that's not happening. We're running $1 trillion plus deficits every single year. So that's not happening. Number 2, well, you could just default, right? Just say you're not going to pay back the money, but of course that's off the table. A U.S. default collapses the entire global financial system, and of course we have a money printer, so why would we? Well, there's a third option, and that's grow faster than the debt, and so maybe GDP could just grow naturally faster than the debt's going up. That might be good. Maybe AI could accelerate this. Maybe we might see more productivity, but it's uncertain and it's slow. Finally, the fourth option, the one they all choose, is inflate the debt away. That's the only realistic option that's left. Now, look at what's happening here, right? The Fed is, again, right now, cutting rates.
Yeah.
Real inflation, food, healthcare, housing, it's all running hot, right?
Correct.
It's about 50% above what the official numbers want it to be.
Correct.
And every structural advantage that the U.S. had in the 1940s, younger populations, industrial dominance, 15 to 20% saving rate, it's all gone. Now today, the savings rate in the U.S. is about 3 to 4%. So there's no cushion there. Now, the 1940s version of this playbook, it was improvised, right? They were figuring it all out as they went along back then. But today's version, it's deliberate, it's fixed, it's optimized. They've had 80 years of data proving it works. And now we can see this is exactly shaping up. We can see the new Fed chair nominee, Kevin Warsh, he's been nominated, and he's publicly calling for a new Fed Treasury Accord. Same thing. Now, again, in 1951, that accord ended yield curve control.
Correct.
Now, why would he be talking about that unless the same structure is already being considered?
Correct.
Well, that's the same playbook being dusted off. And the vehicle this time, it's your retirement account. It's your brokerage, it's your bond holdings. It's anything denominated in dollars that's supposed to be safe. Okay, so now most people...
Wait. We got to pause right there. Right there. Guys, he just said that your retirement account is what they're coming after. That's a 401k, an IRA, Roth IRA, 403b, TSBs. Pick one. They're coming after it. Again, I want to say this again. This is the reason why Robert Kiyosaki said things like savers are losers. Because of the fact that, as you just saw, the system has changed. And what's happening is because the system has changed now, right? You went from an equity-based system, gold, right, back to the dollar, to a Nixon divorce the dollar from the gold, turn into a fiat currency, which has a 100% failure rate, right? Now we add a third change of system because we went from equity-based system to a leverage-based system now. Now we're going into another type of system. Let's keep it going. We're almost done.
Hear what I just explained, and they do one of a couple of things. The first group, they're probably not even paying attention. They don't even know. So they just continue to do what their financial advisor tells them to do, maybe what their plan administrator does. And that's most commonly something either called a 60-40 portfolio. So that's 60% stocks, 40% bonds. Or maybe it's something more like Ray Dalio's all-weather portfolio. The thing is, for both of those is they have significant bond exposure. And as I just explained, the way this playbook works is by crushing bond holders, liquidating them. So the portion of your portfolio that's supposed to be safe, the bond part, it's not protecting you. That's the part.
Now, remember he just said crushing bond holders. How does it actually affect your retirement account? Because what is your pension stuff based upon? Bonds, treasuries. So if they're going to crush bond holders, right? Investors that actually have their dollars attached to government bonds, who loses? Those bond holders, which means your retirement. Just saying.
Part that's being liquidated intentionally. So whether you're on a basic 60-40, or you're spread across 17 different asset classes that you probably don't understand, your safe money is funding that liquidation, the deleveraging. So while it looks responsible, you're thin everywhere and you're deep nowhere. All right, now there's a third group. Now, they're probably watching these videos. Maybe you're watching Lynn Alden or Luke Gromman, right? And they figured out a system. They know it's rigged, right? They understand what I'm talking about. They understand that they're going to need huge returns to offset this massive liquidation of debt. And so those people, they start chasing trends. They buy pumps. They start day trading. They're doing some complex option strategies. They're looking for meme stocks, right? Small crypto coins that can pump. Whatever they could do to try to outperform this inflation. But they're swinging for the fences with no structural edge here, right? Most of them give back everything. They make some, maybe, and then some, they give it back. All right, and then there's a fourth group that actually gets it at least partially right. So they go buy the assets, right? They hope those assets are going to outperform inflation on their own. So let's take a look at what this looks like. So let's say here, if you look at my screen, you can see, I have, $100,000 to invest. And so what I'm going to do is I'll say, well, I guess I'm going to buy some real estate here. So I'll buy a $500,000 home here. Maybe I'm going to buy some Bitcoin here, and then I'll buy some NASDAQ stocks right here. So now I have 3 different assets. I split this money up, and I have 3 assets that are giving me a blended return, okay? But the thing is here is that every dollar they invest is doing one job. So you have $1 in Bitcoin, and that's in Bitcoin, and that's great. You have $1 in real estate, and it's in real estate, and that's fine. But as you can see, this is all horizontal investing. So it works, but you're limited by how many dollars you have.
Correct.
Now, if you're trying to outrun a government printing press, but you have a fixed stack of dollars with
can't.
each dollar doing only one thing, then the math isn't going to work long term. So the question is, what do the top 1% do differently? Well,
Listen.
they don't diversify wider. They stack deeper. Instead of spreading across 17 things like Ray Dalio may recommend, they only pick 2 or 3 assets, 2 or 3 that they understand, and they get each dollar doing multiple jobs. You see, $1 buys real estate. The equity in that real estate, it could buy Bitcoin. The Bitcoin could collateralize into more assets, and that is not horizontal, that's vertical.
So again, guys, real quickly here, as you can see, the goal that they're doing is the reason why governments love deficit spending is because of the fact that they get to borrow from the future to pay for today's bills, right? They get to manipulate the numbers, which they'll leave out of the government debt, Social Security, Medicare, and Medicaid, right? Which is really in the $173+ trillion in debt owed. So even the $31 trillion that we saw in GDP valuation, that doesn't make any sense at all, because we owe a ton more than the valuation of our economy. So all they have, guys, to do is to inflate the debt away, just inflate it away. It's all they can do is inflate the debt away. That's all they have. It's all they have, guys. That's it. And what happens is what's happening is by inflating the debt away, what they do is they attack the government bonds and treasuries, which is what your retirement is based in. It's based in that. Okay, it's based in that. Guys, this is real time. Real time. Unfortunately, guys, I have to end the show a little earlier. I got a text message from family. It says 911. So it's an emergency. I have to go. I think all is okay. But when I get those text messages, I normally, what I try to do is make sure that I see what's going on. But I will run this back again, most likely this weekend, to go a little bit more deeper, guys, on this. So you won't miss anything at all. So I'll rerun this back again, and we'll go to the second portion of it. All right. Second and third portion. All right, guys. God bless you. See you guys tomorrow on Roasted Friday Live, guys. All right, y'all. Holla at y'all in a little bit. Peace.
Long live the